Today, we're backtesting the turn of the month effect. It's a seasonal calendar strategy you've probably heard about. The claim is that a disproportionate share of the market's long-run gains shows up in just a few trading days each month, right around month end. We'll compare it to simply buying and holding the S&P 500 from 1995 through 2024. This is backtested strategies, real tests, hard data, no spin. If you want to see how trading strategies behave in rigorous backtests using professional tools and data, you're in the right place. Turn of the month trading rules. For this backtest, we're using daily bars on SPY from a professional data provider with prices adjusted for splits, dividends, and other capital actions. The monthly turn strategy is based on the well-known turn of the month calendar effect. There are no moving averages or indicators, just the trading calendar. A buy signal occurs on the last trading day of each month. At the close, the system buys SPY with 100% of equity. A sell signal occurs on the third trading day of the new month. At the close, the system sells the entire position and goes back to cash. That's it. The strategy is invested from the month-end close through the close of the third trading day of the new month and in cash the rest of the time. Each strategy starts with $10,000 of capital. The evaluation window runs from the start of 1995 through the end of 2024 using full calendar years. That's 3 decades of data spanning multiple bear markets, powerful bull runs, and sharp volatility shocks along the way. Trades execute at the close. Every trade pays 1 basis point per side in costs, 1 to buy and 1 to sell. When the system is in cash, cash earns 0%. We do not model taxes, advisory fees, platform fees, or financing costs. And our benchmark is straightforward. We buy SPY once and just hold it through the end of the test using the same backtest settings. Let's dive into the numbers. But first, a quick disclaimer. This video is for educational purposes only. It is not investment advice or a recommendation to buy, sell, or hold any investment. Any performance shown is hypothetical and based on historical data and specific assumptions. Past results are not indicative of future outcomes. Please pause now to read the full disclaimer on screen. All right, let's have a look at the scorecard and walk through the head-to-head performance metrics. We'll go section by section in the same order you see on screen. Section 1, Exposure. For the monthly turn strategy, time in the market is 19.1%. That works out to 12 trades per year, and the win rate is 61.1%. For buy and hold, time in the market is by definition 100%. Trades per year and win rate are not meaningful because the position is held continuously. Section 2, Risk. For the monthly turn strategy, annualized volatility is 7.2% with a max drawdown of minus 22.3%. The Sharpe and Kalmar ratios are 0.6 and 0.2, respectively. For buy and hold, annualized volatility is 19%, with a max drawdown of minus 55.2%. The Sharpe and Kalmar ratios are 0.6 and 0.2. So yes, monthly turn is much smoother, but the risk-adjusted ratios are essentially the same. The strategy trades a lot of long-term growth for a calmer ride. Section 3, Payoff. For the monthly turn strategy, the compound annual growth rate is 4.2% and ending capital is $34,129. Whereas for buy and hold, the compound annual growth rate is 10.8% and ending capital is $217,879. So here's the headline. Monthly turn is a calendar-timed risk filter, not a full-time strategy replacement. However, the details depend heavily on which time span you're in, and that's where things get interesting. Now that you've seen the scorecard, let's look at how those results show up over time on the equity curve. The gold line is monthly turn, and the dark line is buy and hold. Notice the shape of the gold line. It stair steps, then flat lines. That's not slow compounding. It's the strategy sitting in cash because it only holds SPY from the end of the month through to the close of the third trading day. And it's out of the market the rest of the month. That design creates the core trade-off you see on this chart. Part 1, Crash Protection. When you zoom into the major stress regimes, monthly turn tends to sidestep much of the worst equity curve cliffs. On the chart, Those are the moments where the dark line falls into a deep drawdown valley, and the goal line either dips modestly or keeps grinding higher. From January 2000 to the October 2002 low, monthly turn is only down 3.9%, while buy and hold is down 44.4%. In the COVID air pocket from February to March 2020, monthly turn is up 5.5%, while buy and hold is down 33.7%. And in the January to October 2022 rate shock, monthly turn is up 6.9%, while buy and hold is down 24.5%. Part 2, Missed Melt-ups. The flip side is what happens when equities compound for years with no sustained drawdown. From the March 2009 bottom to the February 2020 high, monthly turn is up 52.1%, while buy and hold is up 520.4%. From the March 2020 low to the January 2022 high, monthly turn is up 18.3%, while buy and hold is up 119.9%. So the equity curve is the strategy's personality in one picture. Monthly turn can materially mute drawdowns in ugly regimes, but it can also miss a very large share of long-run compounding when the market is trending. To recap, we've reviewed the scorecard and walked the equity curve, highlighting how this trading strategy behaves over time. Now let's step back and summarize the benefit, the cost, and what role, if any, it could play in a portfolio. The main benefit is risk control. The monthly turn strategy concentrates exposure into a narrow, calendar-driven window. On the equity curve, that typically shows up as smaller drawdown valleys, quicker recoveries, and fewer long stretches spent underwater versus buy and hold. The cost shows up in missed compounding. Because the strategy is in cash for most of the month, it tends to miss a large share of the index's compounding engine. In sustained bull markets, buy and hold can stack gains day after day, while monthly turn only stair-steps around the turn of the month, so the gap can widen over time. Given all of that, what role is monthly turn best suited for in a portfolio? This looks most plausible as an overlay, not a replacement. In this test, it behaves like a calendar-timed risk sleeve that can help mute drawdowns and fast sell-offs, but it also tends to lag badly in long-trending bull markets. At Backtested Strategies, we always include a short bonus section at the end of our videos for viewers who want a tuned variant of the same idea. So thanks for sticking around. For this turn-of-the-month strategy, we ran a comprehensive parameter sweep, and one configuration really stood out across this historical window. We'll show the results right now. And to receive the tuned parameter pack for this test, go to backtestedstrategies.com/TOM. The link is also posted in the video description. Section 1. Exposure. For the standard version, time in the market is 19.1% with 12 trades per year and a 61.1% win rate. In the tuned version, time in the market increases to 23.3%, trades per year stays at 12, and the win rate ticks up to 62.4%. So the tuned version participates more without trading more often, and the win rate improves slightly. Section 2. Risk. For the standard version, volatility is 7.2% with a max drawdown of minus 22.3%. The Sharpe and Kalmar ratios are 0.6 and 0.2. For the tuned version, volatility rises to 8.1%, but max drawdown improves to minus 20.6%. The Sharpe ratio increases to 0.8, and the Kalmar ratio increases to 0.3. So for about 1 percentage point more volatility, the tuned version shaves drawdown and posts higher risk-adjusted metrics in this sample. Section 3. Payoff. For the standard version, the compound annual growth rate is 4.2%, and ending capital is $34,129. For the tuned version, the growth rate is 6%, and ending capital is $57,076. So a small rule tweak reshapes the payoff profile in this historical test while keeping drawdowns in the same general ballpark. The takeaway is not that there is a single perfect setting. These results are based on this specific SPY history and set of assumptions. The point is that systematic parameter choices can meaningfully reshape how the strategy behaves, especially for calendar rules where small window changes can have large effects. Remember, go to backtestedstrategies.com/TOM to get the tuned parameter pack for this backtest. We'll email you the exact settings and implementation notes. Click the video on screen to watch the next backtest and subscribe to get new episodes. Thanks for watching Backtested Strategies. Real tests, hard data, no spin.